Coming up on the program today, the World Bank says COVID-19 to plunge global economy into worst recession since World War II. Nigeria's foreign trade declined 17.94% in the first quarter of 2020. An African Development Bank unveils strategy roadmap to safeguard food security against impacts of COVID-19. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwagu. Let's tee off with intraday market numbers. Here on the African continent, the Nigerian stock market was the sole winner amongst the markets we track here. The all-share index was up 0.44%. The JSE index went south, down 0.80%. The market in Egypt was also down 0.25%, and Kenya closed in the green on Monday. And in the Middle East, all the markets we track went south at intraday. Dubai stock market was on course to snap 6 sessions of gains, pressured by losses in real estate shares. The main share index retreated 1.82%. In Abu Dhabi, the index declined 0.84%, with top lender First Abu Dhabi shedding 1.7% and Emirates Telecommunications losing 1.8%. Saudi Arabia's benchmark index was down marginally by 0.06%. The Qatari index slipped 0.62% as Qatari Islamic Bank eased 0.4%, while Masaid Petrochemical dropped 1.1%. In Europe, stocks edged lower in the morning as investors weigh up the prospects of economic recovery after the coronavirus pandemic. Let's hear more from Conrad. Hello, Conrad. Good afternoon.
Good afternoon, Chimi, and hi to everyone watching in Nigeria.
So, Conrad, Nasdaq has reached a new record high yesterday, while the mood in Germany and on most other Western European bourses is very subdued. What's wrong?
You know, Chimi, during the last few weeks, while the German share index and most Western European bourses kept rising, what also kept rising was unease among many investors. Unease about this strong upswing. It is, of course, quite aware. People on the markets are quite aware that this increase of company share prices basically had mostly to do with a lack of alternatives, with central banks keeping interest rates so low, interest rates sometimes even in negative territory. Fixed income investments are really no alternative. That's why this rally on the stock market here has been called by many one of the most hated rallies on the stock markets. It's simply on the stock markets. It's simply not enough driven by optimism for the economy, by the perspective that soon businesses will prosper again, and for good reasons. I mean, if you look at interest rates and central banks, 22.3% of the world's GDP is now represented by central bank money, and that compares to the year 2007, when only 7% of the world's GDP was made by central bank money. People on the markets are quite aware of this. They explain to me that this is the reason why the markets are so volatile and why investors are so quickly willing to take profits after a couple of weeks of rising stock prices.
Our German exports in April fell by a record 31% year on year, more than what economists had forecast. Any silver lining for Europe's economic powerhouse, Germany?
Well, if you want to see a silver lining, then you can say that now, after those very dismal numbers, and those are not the only dismal numbers, not only the German exports are down, also industrial production, also factory orders. A majority of economists now are convinced that this is it, that while the month of April was the worst month on record when it comes to economic data releases, the months of May and June will be among the strongest ones. Now, this is, of course, something that gives a little bit of reason for optimism. The question at the moment, very much discussed on the trading floors, is what happens mid-term. The mid-term outlook is pretty unclear. If we look at the United States, for example, the CBO, the Congressional Budget Office, just came out with a perspective that says that the US economy will reach pre-corona momentum only by the end of this decade. So we have to really get prepared for a long run there. Here in Germany, the discussion is very much what are the supply chains doing, those integrated supply chains, worldwide supply chains of our manufacturers, especially the situation with China has a lot of question marks attached to it. And also this discussion means that many on the markets are preparing rather for investments in the future and not so much for company earnings.
In the meantime, mergers and acquisitions might represent a new driver for stock markets. There's talk about a takeover battle for Grubhub, a food delivery service in the United States. Tell us more.
Yes, Grubhub is the number 2 on the American food delivery market. The number 3 is Uber Eats, and the number 1 is DoorDash. And for a couple of weeks now, we've been having and hearing rumors that Uber is interested in taking over Grubhub. This has pushed the share price of Grubhub significantly. Now, the rumors have come out that also the Germany-based Delivery Hero and maybe even the Netherlands-based Takeaway might be preparing a bid for Grubhub. That's, of course, positive news for the markets in general, because it shows that the overall reflex of business strategists, also investment strategists, that if you have a market with several competitors, then you have consolidation, and then there's something, or then there are opportunities for investment people to make money, that this reflex is still there. What also many on the markets are predicting is that we are going to see consolidation in sectors that have been particularly hit hard by the corona recession. That, of course, is not something that most people on the markets are so positive about, even though, of course, also with this kind of consolidation, there's money to make from the point of view of investors.
All right, Conrad, thank you very much for this update. Enjoy the rest of the day. And while the Eurozone GDP number is slightly better than expected, European stock markets continue to slide after last week's rally. But let's see what the intraday numbers are saying in the UK. Juliana joins us now. Hello, Juliana. Good afternoon. Well, are the UK market numbers reading the Eurozone GDP figures?
Good afternoon, Chimeze. No, they're not. Of course, Britain isn't in the Eurozone. And even though Europe is just a stone's throw away over Dover, there are so many domestic issues that Britain are keeping an eye on. The traders don't seem to have batted an eyelid. But there is triple-digit losses in the FTSE at intraday. And mainly it's come from the oil majors. Brent crude is trading much lower today. So BP and Royal Dutch Shell are down between 5.1 and 2.4%. We've also had some recruitment figures out which are not too great, and we'll discuss those later. The FTSE All Share is down then by 1.79%. The FTSE 100 is down 1.66%, and the domestic market, the FTSE 250, down by a whopping 1.85%. In currencies, the pound is also down against the dollar by 0.63%, down on the euro by 0.5%, and down on the Japanese yen at intraday by 0.99%.
And the UK government saw some kind of near-record demand for its new 30-year bond that was sold at £9 billion of the October 2050, which pay a coupon of about 0.625%. What drove that demand in the bond market?
Debt is in high demand at the moment, and that's lucky for the British government, who are, of course, spending at a rate they haven't seen in recent history. And so investors are shifting away from safe havens, and they're putting their money into these government bonds because they're hoping for greater reward at high risk. This has also been coupled with the Bank of England expected to put in another £100 billion worth of quantitative easing. Now, this isn't unique just to Britain. Britain. We're also seeing this in Spain. We're seeing this in Ireland, and we are seeing it dotted around across the Eurozone and in America. Now, this 30-year government bond, £9 billion was raised, but the interest was over £70 billion. So it just goes to show that the government borrowing bond is getting a lot of interest, and it has been racked up very swiftly to the lucky of the central bank in England.
All right, you did mention the recruitment data, of course, UK jobs outlook, gloomiest in nearly 30 years amid COVID-19 pandemic. That's according to this recruitment firm, Manpower Group. So how is this report being read and interpreted, and what sectors of the economy that this report point out to be the highly affected?
It's interesting, actually. Like I said, we did have a triple-digit fall on the FTSE, and a lot of that was actually pushed by this survey by Manpower, which suggests that in the next 3 months, you're more likely to see bosses firing staff than hiring staff. And there wasn't actually a specific sector. This covers all sectors of the economy, and that's really because of the furlough scheme. We've been speaking about the furlough scheme for months. It is seen as one of the biggest employment subsidy schemes in the world during the COVID pandemic, and it's costing the government about £15 billion currently to keep employers keeping their employees employed and in jobs. When this comes to an end, there are fears that thousands of people will be made redundant. BP have announced job cuts. The airline have announced thousands of job cuts. But of course, if you want an economy to grow, particularly in the West, you need people employed. You need all of these new skills. And there are concerns that this just won't be happening. And Manpower have said this is likely to be hit the most between the months of July and September.
Well, let's keep tracking those numbers. Thank you very much, Juliana, and enjoy the rest of the day. And stocks in Asia Pacific were mostly high today as investor sentiment continues to remain elevated amid an easing of coronavirus lockdown measures. Shares in Australia, which returned to trade following a Monday holiday, led gains of the region's major markets as the S&P ASX 200 surged 2.44%. Meanwhile, Hong Kong Hang Seng Index advanced 1.88%. The Chinese stocks edged higher on the day, with the Shanghai Composite 0.62% up, while the Shenzhen Component added 0.61%. Elsewhere, the Nikkei 225 in Japan closed 0.38%, while the Topix Index shared 0.14%. South Korea's Kospi rose 0.21%. Overall, the MSCI ASX Japan Index advanced 1%. And futures contract tied to the major U.S. stock index slipped nearly in early trade today, shortly after the S&P 500 index and S&P returned to positive territory for the year. Well, the moves early this morning follow sharp gains on Wall Street on Monday as the S&P 500 returned to positive territory for 2020 as fears over the coronavirus continued to give way to optimism about the reopening of the American economy. The S&P, the job openings data and small business optimism numbers await investors on Tuesday, while companies Chew, GameStop, and Tiffany are slated to report quarterly earnings. We move away from the markets now, and the World Bank forecasts the global economy will shrink by 5.2% this year, owing to the swift and massive shock of the coronavirus pandemic and shutdown measures to contain it. This would represent the deepest recession since the Second World War, with the largest fraction of economies experiencing declines in per capita output since 1970s. In its June 2020 Global Economic Prospects, the World Bank anticipates economic activity among advanced economies to shrink 7% in 2020. The bank says the economic activity in the sub-Saharan Africa is on course to contract by 2.8% in 2020, the deepest on record. However, growth could resume to 3.1% in 2021, assuming the pandemic fades in the second half of the year. Sub-Saharan Africa faces daunting hurdles to contain COVID-19, given weak healthcare capacity, lack of access to basic sanitation, and the prevalence of informal economic activity across much of the region. And when we come back after the break, African Development Bank unveils strategy roadmap to safeguard food security against impacts of COVID-19. That and more after the break. And the value of Nigeria's total trade declined by 17.94% at 8.30 trillion naira in the first quarter of 2020 when compared to the value recorded in the fourth quarter of 2019, but increased marginally by 0.80% year-on-year. The latest data from the National Bureau of Statistics shows that the value of total imports decreased by 21.08% and total export value decreased by 14.42% in the first quarter compared to the value recorded in the fourth quarter of 2019. It states that a trade deficit of 138.99 billion naira was recorded during the quarter, making 2 consecutive quarters of negative balance of trade as the value of the imports surpassed exports due to the global slowdown in economic activity as a result of the COVID-19 pandemic. Crude oil, Nigeria's dominant export, accounted for 2.9 billion naira, representing 72.12% of total exports in the first quarter, while non-crude oil export was valued at 1.13 billion naira, representing 27.9% of total exports during the period under review. And the African Development Bank has unveiled a strategic roadmap of projects and programs to assist African countries in tackling the nutrition and food security aspects of the COVID-19 crisis, though through a raft of immediate and longer-term measures. The Feed Africa response to COVID-19, FARC, paves the way for a comprehensive intervention to build resilience, sustainability, and regional self-sufficiency in Africa's food systems and help farmers cope with coronavirus-related disruptions to the agricultural value chain. A report released alongside the roadmap recommends immediate, short, and medium-term solutions for the agriculture sector, including support of food delivery for the most vulnerable, stabilization of food prices, optimization of food processing, extension support services, and provision of key agricultural inputs through smart subsidies. According to the report, the bank will prioritize policy support to enhance movement in inputs and food, to establish food security task force in countries, and to strengthen the capacity of regional organizations to monitor multi-country initiatives. FARC forms one part of the bank's COVID-19 response facility of up to $10 billion. The CRF is the bank's primary channel to deploy financial and technical measures to cushion African economies and livelihoods against the health, social, and economic impacts of the pandemic. And on the commodities market space, our focus is on cotton. International cotton prices are expected to decrease in real terms as world cotton demand remains under pressure from systemic fibers, notably polyester. Let's put this in perspective with Aisat Dahoud, one of the research analysts with Financial Derivatives Company. Hello, Aisat. Good afternoon. Thank you for joining us.
Hi, Chi.
Now, the 2018-2019 global cotton demand was 26 million tons and is expected to contract by about 10.6% in 2019-2020 planting season. Now, major consuming countries like China, India, Pakistan have been affected by the coronavirus infection. What do you think will be the impact of the supply chain disruptions to the global output and price of cotton?
Cotton is a cash crop majorly consumed in China. So restricted movements in the global supply chain for commodity, from movement of commodity from one place to another, restricted movement in order to curb further spread of coronavirus have caused supply chain to be restricted to only essential commodities. So the impact of this restriction or this disruption in supply chain would be profound on essential items like food, more than it would be on cotton. So there is this impact. The impact of this explains the decline in cotton consumption. That's the 10% decline from that to about 23 million tons in the cotton demand. So this significant decline can result to supply glut. And if there's supply glut, so okay, now this planting season, this 2019-2020 planting season, cotton demand is expected to drop, and then the supply is expected to increase by 1.3%. So this difference is when the supply is more than the demand, is going to put a downward pressure on prices. And thankfully, the cotton as a commodity itself, the price increased significantly in previous season. That's 2018, 2019. An increase in price of about 9% counterfeited this price variation that is caused by the pandemic effect. So currently, cotton is trading at $1.5 per kg, and this is expected to remain stable over time as the economic begins to ease.
The Indian producer of cotton has a yield per hectare of about 494 kg, while Nigeria, who remains a fringe player, has woeful yield of 190 kg per hectare. What do you think Nigeria can do to improve its yield per hectare in the short and long run?
Yield per hectare is a function of arable land, quality seedlings, the type of fertilizers we use, the cultivation practice. Cotton, importantly, the aridity of the land used to cultivate cotton and the quality of the seed are the two key significant things that can optimize the yield per hectare for any country. A decade ago, India was also a fringe player, just like Nigeria currently is. And, if we use, or if Nigerian farmers should grow from being subsistent, from practicing subsistent farming to commercialized mechanized farming of cotton, I tell you, we can optimize and grow our yield per hectare also, just like the way India has grown theirs over the decade. But like I remember, back in the days, cotton used to be among the commodities that earned Nigeria significant foreign exchange. It used to contribute about 25% to the real GDP, but now it contributes less than 5%. This is the time for us to call on investors, to call on people. Let us rebuild and rebound our cotton industry in Nigeria.
Okay, I said. All right, I said. Now, there is a strong correlation between favorable weather conditions and cotton output. In particular, cotton production is very sensitive to drought. Many leading producers have suffered from drought-related shortages in Nigeria. The acute arid condition has led to, of course, herdsmen migrating away from the cotton-producing basin in the far north. What can be done now to help reduce these arid conditions in these areas and, by implication, improve the yield per hectare of cotton in Nigeria?
Just like I mentioned earlier, to optimize our yield per hectare, we need arable land. We need the land, the aridity level of the land needs to be at a certain stage, and the quality of the seedlings needs to be of so much quality that it can withstand insect infestations that affects the cotton cultivation. So, coupled with the best agricultural practice, we can optimize this. Like I can tell you, we have 264 dams, irrigation dams in Nigeria. Drought has caused low agricultural productivity. We need to utilize these dams that we have in order to manage the water system in the country to be sustainable. We need to formulate policies, and that's drought policies and the devastation policies that can help us sustain our water resources, such that rain-fed agricultural commodities like cotton can be well optimized, and then we get very sustainable yield that will make Nigeria to begin to play like it used to play in the international markets back in the days, and then we'll grow our economy.
All right, thank you very much for sharing those insights there with us. Aisat Dahoud, one of the research analysts with Financial Derivatives Company. And with that, we draw the curtain on today's edition of the program. Thank you for being part of it. I'm Chimezie Obi Iwago.